The precious metal space is very oversold. And I think the question when you have these types of sell-offs always is if this is the end of a trend or are we still in the trend? This is an outstanding window of opportunity. And it's always going to be tricky figuring out which one is which. But just knowing what I said initially in this conversation regarding the structural demand coming from central banks, and imbalances that have not been readjusted after even the repricing of metals, from 5 years ago, one would still suspect that we are strongly here in a long-term secular bull market.
Quick favor before we begin: if you enjoy this video, don't forget to like and share it. Every like and share helps YouTube recommend this video to more people, which really helps the channel grow.
The precious metal space currently sits at a highly critical juncture, showing clear signs of being deeply oversold relative to historical macroeconomic trends. Market participants frequently struggle to distinguish whether sudden, volatile sell-offs signal the definitive end of an established trajectory or merely a temporary correction within a highly resilient long-term cycle. Tavi Costa, a prominent macro strategist and asset manager at Crescat Capital, asserts that persistent central bank buying and deep-seated global economic imbalances strongly indicate that precious metals remain locked in a powerful, long-term secular bull market. He observes that standard monetary policy tools, such as aggressively raising interest rates, are fundamentally inadequate for chasing structural inflation, leaving hard assets uniquely positioned to thrive as the ultimate safe haven. As global fiat currencies face systemic devaluation, capitalizing on these extreme market pullbacks offers a rare window of opportunity for forward-thinking commodities investors. Now, we present the clips from his interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The precious metal space is very oversold. And I think the question when you have these types of sell-offs always is if this is the end of a trend or are we still in the trend? And if so, this is an outstanding window of opportunity. And it's always going to be tricky figuring out which one is which. But just knowing what I said initially in this conversation regarding the structural demand coming from central banks and imbalances that have not been readjusted after even the repricing of metals, from 5 years ago, one would still suspect that we are strongly here in a long-term secular bull market. And if that's the case, you won't get many situations where metals are this oversold relative to being in a secular bull market. And so, I am thinking about this myself. In other words, I've always had some cash in my own balance sheet. Having some cash has always been part of my allocation, although I have a very heavy allocation towards metals and mining overall. But recently, I actually just turned my cash into gold because I don't see the reason to not hold a gold at these such oversold levels.
Right.
When you have positioning also being the same way, sentiment being, I think the Wall Street Journal just put out a piece very negative about gold as well. These are all clues that things are very extreme. And so I've been acting on it recently as well. China has been one of the leading sovereign parties that have been accumulating the metal, but it's certainly a rush towards accumulating gold across multiple central banks. I suspect we'll eventually see something regarding even the US actually buying gold at some point, or announcing that has bought gold over the last few years or something along those lines. But that, we keep seeing these types of headlines on geopolitics that have impacts on gold and other metals. But the real story is that, you want to focus on the structural demand that remains intact, in fact, continues to improve. And that's mostly because of what we're seeing in regards to the level of imbalances that have not been fixed when it comes to the macro situation worldwide. So, yeah, it's an outstanding chart. And I do think this is still a long-term trend of accumulation of the metal. What's going to happen to gold and other metals if once we realize that we just simply cannot be chasing inflation with hiking rates like the market has been pricing in. If you look at 2-year yields, for instance, which basically is telling you where rates are going to be 2 years from now, it's been going straight up. The whole market thinks we're going to embark in a new tightening cycle, which to me is just ludicrous. So at what moment does the market realize that this war is a long-term issue? Oil deserves to be higher because of the disruption, and the Fed cannot hike rates and have to let inflation run loose.
Right.
That's going to be, I think, a very important change in the macro dynamic, in my opinion. The dollar system works because there's a major collateral used by the treasury market that is the most liquid instrument in the world. And also every institution, sovereign institution, owns a significant chunk of it. The problem is we're flooding the market with those for a long time because of the fiscal issues that we have in the country. And it's not like countries are dumping treasuries. I mean, that's also wrong to statistically wrong, at least to claim. However, it is indeed what's happening that when you look at the denominator being in one place and denominator keeps expanding, basically you're seeing that decline that's shown in that chart. Right. So the flood of issuances of treasuries is not being accompanied by the same buyers that used to be participating in that market in a large way, which raises the question, who is going to be the big buyer? And because of that gap in the market, you're seeing the movement in yields. That lack of demand in the market is certainly starting to hurt. That's the type of stuff I pay attention to. Like if that happens to gold at some point, which will eventually, gold goes through its own bear market cycles too. When you have the demand structurally change like the treasury market has, it's hard to bet on this. And so, but eventually the suppression of rates in the US will become a policy, in my view. And the currency is going to be devolved that probably it's going to have to be depreciated substantially. So, I always say this, act accordingly. You have potentially two factors that may change macro in the next 10 years. And that's the suppression of rates, manipulative by the Fed and others. And two, you have a weaker dollar, which today remains very strong. That's going to be a significant shift in the macro setup in the next 10 years. And so there's going to be assets that will perform better in that environment. Emerging markets, gold, copper, silver, and so forth, miners. So, again, act accordingly.
Recent geopolitical shifts and institutional policy moves indicate a massive, coordinated global rush toward resource accumulation and supply chain onshoring. Central banks around the world continue to quietly acquire physical bullion at an unprecedented pace to fortify their balance sheets against systemic fiat risks, while escalating headlines regarding international conflicts further compound structural demand. The persistent, unchecked flood of sovereign debt issuance completely lacks the consistent, large-scale institutional buyers of previous decades, creating a severe structural supply-demand mismatch that naturally exerts intense upward pressure on global bond yields. Actively converting excess fiat cash reserves into physical gold or high-grade mining equities presents an incredibly compelling risk-to-reward ratio at these extreme, negative sentiment levels, making it a premier strategy for wealth preservation. Now, let's get back to the interview.
I feel like also there's a pressure from investors and institutions, large institutions, even the Trump administration now putting together a whole a segment of the government looking into critical minerals and resources. And so all that is changing in front of us. I think that the best thing to say is patience. I'm not sure there's another way to think about it, but I think it's a matter of time. Certainly, I mean, the stuff that is happening in the Middle East and other places, I do feel, my 2 cents on all this, I mean, I think we try to get the lenses from uniqueness that the situation there is something that is unique to that region. But when you look at history, I would say debt creates wars, and we're as indebted as we could be. So we should probably expect more conflicts moving forward. And this trend of onshoring, I would argue, is even bigger than the infrastructure needed for for AI. I'm not sure if you've seen this chart, but if you look at a chart of electricity consumption in China versus other countries in the world, you see that China becoming the manufacturing plant of the global economy, cause its electricity consumption to go this way, while most other countries have been pretty much flat over the last few decades. And I suspect that if we're going to see onshoring, those countries are going to have to see massive electricity consumption as well. But for that, you need also the infrastructure in place to allow that to occur. So it's going to be interesting. Conflicts are not going to go away, and I think we're probably going to go inwards in terms of policies more and more, in my view. But I would say that the political shift is important, but second to that is also important to notice U.S.-based assets are so expensive, and you're starting to see some of that capital flow to some other areas. You compare, let's say, a bank in the U.S. versus a bank in Brazil. You're talking better margins, cheaper, potential growth, much better than the growth there. Think of AI. U.S. has been an incredible place when it comes to source of labor. What would AI do in terms of leveling up the playing field when it comes to quality of labor in those areas? Efficiency, how much would those businesses shift because of those technologies relative to the U.S.? I think the net change in those areas might be even more relevant than in those areas. So I'm paying close attention to it because I think there's opportunities in real estate, there's opportunities in consumer companies, utilities, energy, you name it. I mean, it's across the whole, sectors of the economy, really. So the global recession aspect would maybe delay the cycle, not perhaps end the cycle, but, I think would probably pause for a bit. The biggest thing to me has always been looking at the lenses of, look, we obviously have a lot of imbalances, and how can we fix the imbalance without causing massive inflation? If there's a case to be made there, I think there's a case where hard assets will not benefit from this situation. So let's try to come up with something here. AI maybe could be one of the things where potentially causes massive efficiency and productivity that helps us to increase economic units of growth relative to debt. If that's the case, and we see that over and over and over again, I don't think you want to own hard assets. Now, let me give you the counter that I think is a real counter. In order to see that level of productivity, I would argue we need to have a lot of automation, all the infrastructure ready. So I think we're in the build-up phase of AI. I think 10, 15 years from now, when everything is built up and we're ready to deploy AI in the economy in a large way, I do not want to be long gold, I think. I think it's going to be a different world. I think we're going to go from a very inflationary era to a very deflationary era. I believe in a abundance thesis. But right now, we're in a situation, sorry to go long, but it's so important. It's almost like our old school style of investing, like the Warren Buffett way of looking at the world from a moat perspective, like a company that has something that cannot be disruptive, it has an IP, whatever that is. That world is changing, and you can probably recreate a lot of things with AI today. What you cannot recreate is a good mind. And, I think that resource businesses are going to become the new moat businesses in this new economy, personally.
The broader macroeconomic landscape will likely face a profound structural transformation over the next decade as global protectionist policies turn inward and critical supply chains undergo aggressive infrastructure overhauls. While the current intensive build-up phase of artificial intelligence demands substantial electricity consumption and grid infrastructure, the underlying global dependency on raw physical commodities, copper, and critical minerals cannot be easily replicated or automated by emerging software technologies. Over a longer 15-year horizon, full technological deployment and automation might eventually usher in a highly deflationary era of economic abundance, temporarily making gold less favorable. However, during the current messy inflationary transition phase, tangible resource-based businesses stand out as the ultimate undisruptible economic moats. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.